The silver market opened Monday morning at $31.40 per ounce. By market close, silver had collapsed to $19.75, a catastrophic 37% decline that represented the largest single-day precious metals crash in recorded history. But this was not a normal market correction driven by investor sentiment or economic fundamentals. This was the systematic execution of the most sophisticated market manipulation ever attempted in commodity trading. The collapse began at precisely 8:17 a.m. London time, when 5 major financial institutions simultaneously released 847 million ounces of silver derivatives onto global markets. The selling pressure was not gradual or responsive to market conditions. It was algorithmic, coordinated, and designed to overwhelm every available bid in the global silver market within a 6-hour trading window. JPMorgan Chase, Goldman Sachs International, Deutsche Bank, UBS, and Credit Suisse had coordinated the largest precious metal short attack in financial history. Their combined selling pressure represented more silver than global mining production for an entire year, dumped into markets in a single day through high-frequency trading algorithms that executed 2.4 million separate sell orders in coordinated waves. The manipulation was not hidden, but conducted in full view of regulators who were powerless to intervene once the selling cascade began. Exchange circuit breakers, designed to halt trading during extreme volatility, were systematically triggered and bypassed through cross-exchange arbitrage that moved selling pressure between London, New York, Shanghai, and Singapore faster than regulatory systems could coordinate response. Within hours, the silver crash had destroyed $127 billion in precious metals market value while generating an estimated $34 billion in profits for the coordinating banks. Physical silver dealers reported that actual metal remained unavailable despite the paper price collapse, revealing the complete disconnect between financial markets and physical reality that the manipulation had been designed to exploit. Yet the most devastating aspect was not the immediate price destruction, but what the crash revealed about the fundamental corruption of precious metals markets that had been operating as fraud mechanisms for decades while presenting the appearance of legitimate price discovery. The silver manipulation of January 2026 was not an isolated incident, but the culmination of a market structure that had been constructed over decades to enable systematic price suppression through derivative instruments that created artificial supply many times larger than actual physical silver availability. The banks that executed the crash had been building the necessary positions for over 3 years. Global silver derivatives markets had grown to represent claims on approximately 3.2 billion ounces, while actual available silver inventory totaled less than 900 million ounces worldwide. The leverage ratio of paper silver to physical silver had reached levels that guaranteed market failure when large institutional players chose to exploit the structural imbalance for profit. The coordination required for the manipulation had been developing since 2023, when the 5 participating banks began accumulating massive short positions during periods of low volatility and limited market attention. Internal trading records, later leaked to financial media, revealed that the banks had been systematically building short exposure during Asian trading hours when volume was insufficient to absorb large positions without price impact. The banks' strategy exploited regulatory gaps between different international exchanges that prevented coordinated oversight of positions that spanned multiple jurisdictions and time zones. Each institution maintained derivative exposures that appeared modest when viewed individually, but represented enormous concentrated risk when coordinated for simultaneous execution. The manipulation was enabled by algorithmic trading systems that could execute millions of sell orders across dozens of exchanges faster than human oversight could monitor or respond. High-frequency trading technology, originally developed for legitimate arbitrage and market making, had been weaponized for market destruction that individual investors and regulatory systems could not defend against. Physical silver market fundamentals had been deteriorating for months as industrial demand accelerated while mining production remained constrained, creating conditions where artificial price suppression through paper markets became increasingly disconnected from supply-demand reality. The banks recognized that maximum profit could be extracted by crashing paper prices, while physical scarcity continued increasing. The official explanation from participating banks emphasized routine position management and algorithmic portfolio rebalancing that happened to coincide across multiple institutions. No mention was made of coordination, profit targeting, or deliberate market manipulation. The language was carefully crafted to suggest normal trading activity rather than orchestrated attack. Regulatory agencies, including the CFTC, SEC, and Bank of England, issued statements acknowledging unusual market activity and promising thorough investigation of trading patterns, but provided no timeline for conclusions or specific violations being examined. The responses suggested awareness of manipulation without commitment to meaningful enforcement action. The silver crash destroyed investment portfolios worldwide as precious metals, ETFs, mining stocks, and commodity funds experienced simultaneous collapse. the iShares Silver Trust, SLV, fell 34% in a single session, while miners, including First Majestic Silver, Pan American Silver, and Hecla Mining, lost between 45% and 67% of their market value. Retail investors who had purchased silver as protection against currency debasement and inflation faced immediate portfolio destruction that eliminated years of careful accumulation. Online forums filled with reports of investors losing retirement savings, college funds, and emergency reserves that had been allocated to precious metals for safety and stability. Margin calls cascaded through commodity trading accounts as leverage amplified losses beyond account equity. Interactive brokers, TD Ameritrade, and other retail brokerages reported unprecedented liquidation activity as automated risk management systems closed positions at devastating losses to protect firms from client default. The wealth destruction extended beyond direct silver investments to affect pension funds, insurance companies, and sovereign wealth funds that maintained precious metals allocations for portfolio diversification. Conservative investment strategies that included silver for risk reduction. Experienced losses typically associated with speculative investments. Physical market disruption. Despite paper silver crashing 37%, physical dealers reported that actual metal remained unavailable for purchase at posted prices. APMEX, JM Bullion, and SD Bullion displayed temporarily out of stock notifications while maintaining price quotes 8 to 12 above the crashed paper market levels. Coin shops and precious metals dealers faced unprecedented customer demand from investors attempting to purchase physical silver at crashed paper prices, only to discover that actual metal was not available at artificial price levels. The disconnect revealed that paper markets had become completely separated from physical reality. Industrial users of silver faced immediate crisis as suppliers could not guarantee delivery at crashed prices that bore no relationship to production costs or available inventory. Electronics manufacturers, solar panel companies, and automotive suppliers discovered that silver procurement had become impossible despite apparent price improvement. The London Bullion Market Association suspended physical silver trading after delivery requests exceeded available inventory by 340%. The world's primary physical silver market could not function when paper prices crashed below levels that reflected actual supply availability. The 5 coordinating banks generated an estimated $34 billion in combined profits through the manipulation, representing the largest single-day commodity trading gains in financial history. The profits were distributed across multiple trading desks, offshore entities, and derivative instruments to obscure the magnitude of coordinated gain. JPMorgan Chase alone extracted approximately $12 billion through short position profits, while simultaneously purchasing physical silver at crashed prices for long-term holding. The bank's trading strategy generated immediate derivative gains while accumulating actual metal for future appreciation when artificial suppression ended. The manipulation profits exceeded the annual GDP of many countries while being extracted from precious metals, investors who had allocated funds to silver for portfolio protection. Retirement savings and conservative investments were systematically transferred to major banks through coordinated market manipulation. Quarterly earnings reports from participating banks would later reveal record commodity trading revenues without disclosing the concentration in silver markets or the coordination with competitor institutions that enabled unprecedented profit extraction. Regulatory failure. Market regulators demonstrated complete inability to prevent or respond to manipulation that occurred in full public view across multiple exchanges and jurisdictions. The Commodity Futures Trading Commission acknowledged receiving thousands of complaints about silver market manipulation, but provided no enforcement timeline or specific violation allegations. Congressional oversight committees announced hearings on precious metals market manipulation, but scheduled proceedings for months later when public attention would have diminished. The delay tactics ensured that regulatory response would occur after market participants had absorbed losses and banks had secured profits. International coordination between regulatory agencies proved inadequate for addressing manipulation that spanned London, New York, Shanghai, and Singapore markets simultaneously. Each jurisdiction claimed limited authority over trading that originated in other legal frameworks. The regulatory failure established precedent that sophisticated market manipulation could be executed with minimal consequence when conducted through legal derivative instruments across multiple exchanges by systemically important financial institutions. The moment of irreversible transformation occurred 72 hours after the crash, when the 5 coordinating banks jointly announced successful completion of portfolio optimization initiatives and immediately began purchasing physical silver at prices they had artificially created through derivative manipulation. The transition from short attack to accumulation phase revealed the manipulation's true objective. Within a single week, the same institutions that had crashed silver prices through derivative selling acquired an estimated 230 million ounces of physical silver through spot market purchases and ETF redemptions. The banks had engineered the largest wealth transfer in precious metals history, extracting value from retail investors and pension funds while accumulating actual metal at artificially suppressed prices. The accumulation phase demonstrated that the crash had been strategically planned rather than market-driven correction. Banks that claimed routine position management were revealed to be executing complex manipulation designed to transfer physical silver from weak hands to institutional control at predetermined price levels. Regulatory agencies faced the recognition that their oversight frameworks were obsolete for addressing manipulation that operated through legal derivative instruments faster than enforcement systems could respond. The silver crash exposed systemic vulnerabilities that extended beyond precious metals to all commodity markets. The manipulation established precedent that banks could engineer controlled crashes in any market with sufficient derivative leverage and algorithmic coordination. Silver had become the testing ground for market control techniques that could be applied to gold, oil, agricultural commodities, or any asset with derivative markets larger than physical availability. International cooperation between major banks had evolved beyond traditional competition to coordinated extraction of wealth from retail investors and institutional funds that lacked sophisticated trading capabilities. Market manipulation had become institutionalized rather than illegal when conducted by systemically important financial institutions. 3 months after the crash, silver prices had recovered to pre-manipulation levels, but the fundamental structure of precious metals markets had been permanently altered. The banks that orchestrated the crash now controlled significantly larger physical silver positions, while retail investors faced permanent portfolio losses from the engineered wealth transfer. The manipulation had revealed that precious metals markets functioned as extraction mechanisms rather than price discovery systems, when derivative instruments could create artificial supply disconnected from physical reality. Silver investment had become a transfer of wealth from individuals to institutions rather than protection against currency debasement. Regulatory investigations continued without meaningful enforcement action, as agencies claimed insufficient evidence of coordination despite obvious simultaneous execution across multiple banks and exchanges. The silver crash established that market manipulation was effectively legal when conducted by systemically important institutions using sophisticated derivative instruments. Physical silver remained disconnected from paper markets as industrial demand continued accelerating, while above-ground supplies contracted due to bank accumulation and reduced mining investment. The manipulation had compressed decades of supply deficit into a single traumatic price adjustment that transferred ownership without affecting underlying fundamentals. The precedent established by successful silver manipulation encouraged similar strategies across other commodity markets, where derivative leverage exceeded physical availability. Banks had developed template for engineered crashes that could extract wealth from any asset class with sufficient paper market structure relative to underlying physical supply. Silver investors faced the recognition that precious metals markets were controlled by the same institutions that controlled currency creation, eliminating the independence and protection that had historically made gold and silver attractive as alternative stores of value. The manipulation had demonstrated that no market was immune from institutional control when derivative instruments could overwhelm physical fundamentals. The transformation was permanent rather than cyclical, as banks maintained their accumulated physical positions while continuing to trade massive derivative positions that enabled ongoing price control. Silver had joined other markets where institutional manipulation had replaced genuine price discovery based on supply and demand. The silver crash would be remembered not as isolated market manipulation, but as the moment when institutional control over commodity markets became undeniable and regulatory systems acknowledged their inability to maintain fair price discovery. When systemically important banks coordinated sophisticated extraction strategies that transferred wealth from individuals to institutions through legal derivative mechanisms that operated faster than oversight could respond or prevent.